Hi guys, I hope you're all well. So this is a long-awaited video, something that I've been wanting to do for a while actually. So based on sort of demand, I have been, well, let's say coerced. No doubt. It's an absolute enjoyment to do this, but I have been highlighted that this would be quite beneficial to the masses. Now, I really want to approach this topic of, support and resistance, and what do I mean by yo-yoing in the markets? Now, some of you have a sort of basic understanding of the market. Some of you have a basic advanced understanding of the markets. Now, what I mean by that is literally this. The most popular tool that's used widely are candlesticks. And no doubt many of you have read basic understanding and observations around them, and how each individual candlestick means a certain something or a behavior in the market, and can ultimately turn into strategies based on pattern sequences and trends based on that. So what I really wanted to do is kind of just go into a little bit more detail, but really progressively show everyone the barriers of entry when it comes to trading, or the challenges and tribulations I guess the seasoned traders would face. And despite certain traders using the conventional support and resistance levels, which is what I'm going to go into, they continue to use it. Now, we only do that because I'm in the strong belief that if you haven't got anything as an alternative, if you haven't got anything or proven factually that something else is stronger, of course you're going to use only what you know. And I will be going through examples today of basically the most important things that occur in the markets, and why false breaks occur, why swing traders face this challenge on a day-to-day basis, no matter which time frame they look at, no matter which currency they look at or commodity, or whether they're looking at futures or so on and so forth, or stocks and shares. It's applicable there. So what I'd like to do is start off by saying, look, if you're new to the channel, welcome. If you've been here before, welcome back. And really kind of just start posting a little bit more, so I can give you guys a good insight into who I am, what I do, my understanding of the markets, and try and project that to you in the best way so you can become a profitable trader a lot sooner than you guys think. Now, I won't be harping on psychology too much, but if I do, then it would be likely to be embedded in certain things and certain areas and so forth that we're going to be looking to trade. Now, what are the challenges? Like, why have I said in my title, that in the thumbnail, that guys, look, you'll be yo-yoing if you're using support and resistance levels, and everything's wrong. Support and resistance doesn't seem to work. Well, many of you will know that the majority and the popular masses will be trading in key levels, highs and lows of the charts, and depending on the time frame that you're looking at, they will be trading highs and lows and seeing if they can make money with swing movements when the market's moving up and down. And I guess you can say the idea is, for most people, and what they've caught onto, is that history repeats itself. What goes up is supposed to come down. What comes down is supposed to go up eventually, or so we think. Now, that's not really great for us if we're saying eventually, because unless we can predict that in a certain range of time the market's going to be coming down, then unless you run a trade without a stop loss, only then are you going to be right, essentially. So what I want to go through is basically showing you support and resistance levels, or price action swing trading, which is the most popular concept out there that people maintain and still use, and the pitfalls of it really, and any other kind of trading as well, to understand that, look, if you're going to formulate a strategy and find a strategy based on something in the markets, right, then what we need to do is find the common problem. And the common problem that exists in the market is this. Number one, what we find is that sometimes when we deem history to repeat itself, it doesn't actually do that. And in fact, it does it over a long period of time, or maybe it doesn't even, repeat itself no matter what. So what we've got to understand in particular situations is, rather than be lured into thinking that just broadly looking at the charts, the market will eventually come down, and basing our trading on that impression of trust that we get, for instance, something like this that goes up and comes down, in hindsight, yeah, it's easy to justify something like that. But when you're looking at things broadly, just a glance doesn't compare to you actually having to sit there and wait for the price to come into your favor and come back round and come all the way down to match a previous low, or come back up to match a previous high. In real life, when you're looking at something like this, you can add so many different variations and analysis to say that market was trending downwards or upwards at this point, and it's midway between the top and the bottom area, and then use confluence and correlation with different time frames to assert that decision whether it's market is bullish or bearish. So can we understand things a little bit more concisely than that? So I really want to kind of go into the common occurrences in the market which poses the common problems in the market, and slowly but progressively in the upcoming videos get to the solutions of what we can do to overcome these things. So commonly, no matter where you look at a chart, we find that, look, if you look at support and resistance on its own in the definition, we say that support and resistance as a general sort of definition is key areas where price has responded or hit multiple times. Now, for most people, that would essentially mean when price has hit multiple areas and responded to multiple areas historically, and again, we've got to answer that question of how far do you go back in history, will it do it again? Because essentially, of course, those are your milestones or benchmarks as to where price is going to go. And for most people, what they'll do is, if price responds to a top, ceiling, or resistance, an area that's hit multiple times, which is resistance area represented by an area that's hit multiple times, then people would look to sell off the bounce, or maybe even buy on the break. Now, there is a problem, and some of you may already be able to see this right now in front of your eyes, but I will highlight that for those who are fairly new to it, and for those who want to understand, of course, like solutions to this. Now, number one, how often does this happen? Well, I can say without unequivocally giving you the answer of how many actual times it happens, I can say that it happens far too much to ignore. Far too much to ignore. Now, when looking at conventional areas, or what I call conventional areas, whether it's a support and resistance or so forth, let's pick this area right here, an area that's hit multiple times, and let's pick a low area, something like this. So what we've done essentially is we created a channel, an area or a channel which basically allows us to confine the market to that space to try and understand the behavior that occurs within, and maybe even make some money. Of course, that's the goal, right? So when people are drawing a channel as such, they have picked a high area and a low area, or a seemingly low area, depending on what time frame they're looking at and how broad they want to look, meaning that I could even choose a high area up there and a low area down there to determine how price is behaving between there. And what I mean by how price is behaving is that, well, we'll go with the mass populace in terms of what the most popular strategy is out there right now is price action swing trading, essentially. Now, swing trading is the concept that looks at swings or highs and lows, and basically represents areas where you can try and make money between, and where price essentially oscillates and ranges between that area. Now, looking across this example just here, you can actually see, and what we'll do is we'll make it a little bit more clear. Well, there we go. We'll grab a little. That's it. That's the one. There you go. So looking broadly across this area, what we'll find is this area has been hit multiple times, which is what will give us the incentive that, do you know what, if price comes back up there again, we might be able to do something. What we've seen is that singularly looking at this area here, for example, and this area here where we initially drew the areas of interest, we were and we would be looking for price to respond at the top and the bottom of that ceiling and that floor to see if we can buy upwards and sell downwards between here. Now, as you can see, price is ranging between there. And for most part, it's actually ranging quite cleanly and quite clearly, actually. However, with closer inspection, what you'll notice is there are particular breaks at certain areas. Now, if I just move these over here, what you'll notice is a break there and a break here. And why not? We'll draw one more here. So if we were to focus on just this area right now, we can see, and there are a few more down here as well, but if we were looking at this area just here, we'll find ourselves in a bit of a predicament, because this means, according to swing traders, and let's go by that, the mass populace and what they look at, that if you're going to sell at the bounce of the top, just like a bouncy ball essentially, sell at the top and buy at the bottom, just in its raw form, as a swing trader, then what you'll notice is that price respects those areas quite well, generally speaking. However, when we look slightly closer, slightly more closely really, then what we'd see is that price doesn't exactly get to the areas that it was intended to. Now, what do I mean by that? Okay, well, let's take this initial area here that we were looking at, these two areas, the high and the low, and let's imagine that we were looking at it like this. So essentially what we're hoping is that if price was to respond and go upwards and bounce again in relation to the previous area, right, at the notion of history repeating itself, then most traders would probably likely sell from this point downwards. Now, it's all good and well, right? Because in this particular situation, actually what happened was price did go down and actually it went to the floor. So if one was to sell at this particular point and go short, sell downwards to this low area that we've highlighted and benchmarked as a low point, then price did respond to this. So essentially, yes, you would have made some money. But let's go into a little bit more detail to understand when price went there, what would have given us an extended and more advanced understanding, still in line with price action swing traders, the most popular principle that people use. What essentially would have happened at this particular point? Now, what price action swing traders are doing are they're looking for particular candles to try and understand intricately that rather than just price bouncing, I mean, what is bouncing, right? Rather than price just bouncing and responding here and selling downwards, they'll look for a singular candlestick that will give them the incentive that actually, yes, this is a signal for a sell trade. And usually the type of candlestick that people look at in this area are rejection type candles, which are formed from a long wick and a body at the top, and a bottom heavy body and a long wick at the top, which suggests that buyers were buying but sellers sent, but basically they were taking their profits out at a lower area because the push from the sellers was quite heavy and the market started reversing at that point. This is quite a common indicator for people to go into a sell trade or a short trade down to here. So did it work? Well, on the broad scale of things, yes. On the grand scheme of things, absolutely did. However, when looking into detail, what we find is in any trading system or anywhere, that a successful system is based on your stop loss. Now, what is a stop loss? We'll go more into this in particular videos, but I assume that you guys are here based on the title, knowing a little bit about FX and risk management and so on and so forth. So what would essentially be a good stop loss to put in this area? Now, for this, the most common trader would look at a previous high and they would benchmark it by putting a little bit higher than the previous high and going short after that. Now, if they were to sell at that particular point, you weather the storm there because you're getting in at the close of this candle and going short. However, here's the thing. Now, we said in the broad scale, in the grand scheme of things, yes, if you left your trade open, it would have hit target quite nicely. But not before it created multiple movements between here that would run us through a roller coaster of emotion and essentially really test our ability to stay in that trade, especially at these particular points. Because When you're looking at something like this and you find yourself in profit, and then the market reverses literally from the last couple of seconds of this candle to that candle before meeting your ultimate target which you're looking at, you'd be most likely to look to cut that trade out, take as much profit as you can, or buy and put a buy position, but basically put a buy position on, because it's quite a bullish, strong candle going upwards. And now when we look at something like this, we could see that it didn't quite reach there until a fair amount of time afterwards. Now this is a 4-hourly chart, but it could be any chart really, to be fair. So we're literally just showing you, I'm literally just showing you right here how price responded and why didn't it go down exactly when it was intended to go, and had to create this kind of a movement and a reversal before it came down. What was it necessary? Why does that happen? How frequently does that happen? Well, you know, I can conclude that part by saying that this is such a frequent occurrence, and we'll see that in upcoming examples, and how to essentially negate them. So if we were selling there at this particular point, original, based upon this high area and this low area here, then if we were selling at the close of this candle, based on the idea of a rejection candle here, we'd well be into profit at one particular point. And it came down a quarter of the way to the bottom swing point and the swing low there, but not before it breached previous areas, and where we put our stop loss at that point. Essentially, if price touched there, it would have stopped you out and knocked you out of your trade. So what would you have done at that point? Would you have re-entered? Would you have re-entered based upon the trust that you had before, the wholesome trust you had, and now there's a chance it could repeat itself and do the same thing? How much risk did you have in the beginning? How much risk did you take in the beginning, which will determine whether you can, you know, get into another trade essentially, and go short as well again after just making a loss. And this is the challenge that price action swing trading presents, because as much as it works, it creates a false sense of security multiple times. But it gives you enough to hold your attention. It gives you enough to let you know that, hey, we're creating a false sense of security here, or that's not what it says, but it is creating a false sense of trust or false sense of security for you to trust it. The same way that when you walk into a casino or you walk into a betting shop, what happens essentially is that you're going to win once or twice here or there. Not essentially be successful, but win some sort of money here or there, or your friends would, essentially to keep your attention. So it somewhat has to work for you to pay attention to something like this. But the best of price action swing traders, I can assure you, get no more than 60% successful trades, marked 60% successful trades consistently. So it really varies between 50-60% and 50-65%, and most of you who have used this approach will notice that and the challenges. So as we can see, when we were going short there, it knocked you out of your stop loss, and you had the opportunity to re-enter again, and you may just adjust your line for the next area right here. And when that happens, yes, actually, if you were to move your stop loss at that particular high point and went short, that would be great, because after that candle closed there, and it presented a bottom heavy signal candle similar to this particular rejection candle here, where the wick was longer at the top, and showed that sellers were stronger at this particular point, and maybe even the price was overbought, you could have gone short here again. And yet once again you find yourself at the same target, you're in that trade, but it doesn't quite reach that area, or it doesn't reach that area straight away. And now when you're looking at that, here we go, we'll just hit, oh sorry, beg your pardon. So when we look at that here, we'll find that if you are setting your take profit at this particular area, there is nothing signaling that price is reversing at this point for you to get out of your trade early. Now, a trade, like I said, is determined by your stop loss, or a strategy is determined by your stop losses, where you place them. Doesn't have to be fixed at a particular area. And it's also determined by your take profit target. Now, for most people, they believe that, you know, if you go and sell or buy, whatever you decide to do, if it comes close to your target, you can manually take out your trade. Now, this is all good and well if you're watching the markets. However, we know how relentless the markets can be, and potentially this could reverse before your target. And this is a good example how when we expected, even in a 4-hour candle, when we expected the price to fulfill the rest of the target, where we can see it's gone 3/4 of the way to that swing low, it didn't quite do it immediately. And in fact, unless you were watching this, you wouldn't know the behavior of candles that can occur. Now, this is highly unlikely for candles to reverse in the last moment individually, and for this red to turn green and the green to turn red on a 4-hour or a larger time frame. However, it's not impossible, and this is all depending on news and other influences, of course, but generally speaking, this is more of a wholesome time frame, upwards of 4-hour, that are pretty assured in that direction. And remember, we're not using correlation or confluence or looking at high time frames to assert our decision to sell or buy in that way. And for this one, of course, we're looking at sell. So when selling down here, your take profit target is here. So if you find yourself taking your profit out 3/4 of the way at this particular point, congratulations, you made some money. However, it didn't quite touch the target. Now, if you're watching it, yes, you can take your trade out pretty much prematurely and make some sort of profit there from the point that you entered, providing that you did enter at that point, where some people may have entered late, or you could have been asleep, or you could have walked away from your terminal. And that meant that price didn't quite hit target at that particular point, and it consolidated for a while before it came back down. But let's pretend like we didn't know this for now, right? And up until this point, price reverses. So what would you do? When price closed here and opened here, it could have been a matter of minutes. This is a 4-hour candle. Each one of these represents 4 hours. However, did we know whether this candle here in the last 10 seconds and this candle in the first 10 seconds allowed this to push all the way upwards here, throwing you guys off and throwing us all off our initial trade and our setup? So what would you do? Would you cancel your trade out and capitalize on whatever profit you can take from entering at the top there, or would you leave your trade open? And this is quite a strong bearish candle, which means that, the chances are there was some sort of news there, quite a large candle, and also it was moving pretty fast, no doubt. So to what extent could you call this a profitable trade, bearing in mind that there will be certain situations where, yes, you could take your trade out early, but a lot of the time what's happening is price is reversing at that point and not quite meeting your targets. Now, you could argue that, yes, we have other hard targets between that area which we can take our target towards, but that's all depending where your price closes to the point you want to enter and your stop loss. I mean, you wouldn't put your stop loss at 100 pips and only take 20 pips as your target. It just doesn't make financial sense, So that isn't good risk management either. So when looking at this, your take profit target potentially got missed at this point if you were sleeping, if you walked away from your terminal, and that would throw you into another decision. So what would you do? Would you cut your trade out? Would you re-enter for a buy trade? And if you did, which a lot of people would have done so with this bullish candle, they would have probably looked to buy to, and let's enlarge this a little bit more. There we go. They probably would have looked to buy a little bit more towards, let's say, that higher area there, which it's responded to before, because no doubt when you're looking at something like this, the sentiment is that it's going to go upwards and respond to there, and you'd maybe even have a sell trade and it will bounce down again. So this is a classic example of what I mean by a roller coaster of emotion and yo-yoing. So price has gone up there, and let's remove these crosses now to take away the attention a little bit from those areas just for now. Price has gone up, and most people would be prompted into, a lot of people would be prompted into a buy trade. Some may hold their positions open, having their stop loss up there, and it's all good and well, they would have waited. But for majority of intraday swing traders, generally speaking, they are more likely to hold their trades open and cut them out either 3/4 of the way or basically just look for a buy trade after something like that happens. Now, if you were to buy there, no doubt it came back up to where it was intended to go, not before it created all of this movement here and breached your previous low area. So once it breached your previous low area, at this point, it gives us strong incentive that price is actually coming down now. Maybe it's ready to go, but no, look what happens. Price breaks that floor, retraces back into that area and pushes back up. Now, for most people, what would you do in that situation? Would you assume this is the new floor and use this one? Or would you use the original floor there? And this is one of the challenges and things that I'll be facing, I'll be discussing actually with you guys in the next couple of videos of how to create solutions for this. Now, let's say for the sake of things that we're going to use this as a new floor. And we're going to look for a buy trade when price comes here. What we find is that price actually didn't come down to give you a buy signal. If you are now looking for the reverse, what price action swing traders look for, which is a long wick downwards breaking a previous area and a top heavy candle, which is a rejection candle, that suggests the price is now oversold and buyers are stronger, they're ready to buy, and sellers are taking their profits out early. So at this point, if you were looking for a signal and you didn't get one, would you really break your rules and prompt into a buy trade at this point? And if you did, let's say for whatever reason you did, and you bought right now, where would be your target? Would your target be this area here, this area here? Remember, what we're recalling is the conventional way support and resistance are used. So we're using areas that have been repeatedly hit. And that means that, yes, this is a strong resistance at that top area, which potentially means that it's still active and still possible that it's going to go there. And this is proof that it responded to there. Again, I'm not saying it's right, but I'm saying it's proof that it went there. So when buying at that particular point, what would you have done? Would you have held your trade out open till it hit your TP target there, with your stop loss in the opposite way now, being probably just underneath here, and that held it quite well, and waiting for it to hit there, with sentiments being changed now, because number one, it barely goes to your target, it reaches 3/4 of the way, then gives a series of rejection candles here, and dojis and some rejection candles here, bottom heavy rejection candles that prompt you for a sell trade. So where would your target be now? Would your target be a sell trade? Would you continue to hold that buy trade open or take your profits out? Again, remember, it's easy to say that we would have bought to that particular point and then taken our profit out 3/4 of the way, but this is hindsight. What if it didn't go entirely 3/4 of the way? So we'll be looking at those kind of examples as well to see that, will price always go 3/4 of the way of the swing or 1/4 of the way, and how can we determine that? Maybe price will just reverse a little bit and not entirely give us any profit, just give you a momentary change in direction before it reverses. So now we can get rid of this. Oh, beg your pardon. It's a bit fiddly. There we go. So when looking at these original areas, we can say that, yes, between these areas, whether you look at it later on, prices are essentially bouncing and breaking. There are only two behaviors between any given channel on a chart. Price does two things. It bounces between there inconsistently, which we've shown, and price breaks. And what do I mean by price breaks? Well, if we look here, price broke this roof here. Now, if people are looking for sell trades here and price closes above, what would most people do in this particular scenario? I have you know that the mass populace would probably look to buy at this particular point to the next high area available. Or if it breaks a floor and breaches a floor, they look to sell downwards to the next particular area. Now, when we look at this here, this has done this multiple times. Price has broken a previous area, closed above candles, giving the incentive it's going up. No strong rejections there suggesting it's coming down. And then, until later on, of course, just here, and it reverses. But not before it prompted people into buy trades in the next area at the top. And the same with the sell trade down here, or the break at the bottom point here. When price broke a particular floor, price came downwards and reversed back into the area. Now, one could say, yes, we could wait for the reversal to happen and come back into the area and then target top areas again. But we found ourselves in the same predicament here. If we're not using that top area, which is here, we wanted to adjust things and use a different resistance area, one might use an area like this, which is a little bit shorter, and it's hit multiple times across here and responded in this area. And you'll find yourself falling short once again of an area like that. Remember, your trade has to cover spread, and you need to cover the extra pips in order to, for your essentially for your take profit target to be hit. So we're finding ourselves once again with a problem that price has not quite reached that area. Now you can well look at that and say that's a successful trade because it's gone more than 3/4 of the way and pretty much 4/5 of the way, and you know, you could take your profits out early once again. However, I would say unequivocally once again that how long would you have waited before at this particular point? So it's all good and well if you're awake and you can take your trade out, but what if this price here reversed within the last 10 seconds of that and the next 10 seconds of this candle and dropped downwards around here? Once again, where you would have entered, wherever it is here, you would have lost a lot of profit out on it. So this would prompt people to cutting out their trades, and for most people they would look to sell as well. So would you be wrong in this particular point if you were to sell downwards to the new support, which would be essentially here? See, hit multiple times and responded there. You wouldn't. This time it's a little bit more easy flowing and actually quite a clean move, and that's on its own without looking for any rejections at the top. So remember, just looking at this in its raw stance, you can see in its raw form that price is moving up or down, but it doesn't always happen. So price action swing traders sweeten that trade decision by finding rejection candles like this to determine whether price really is coming down and really is reversing that particular point, and if it truly is overbought. And then a series of other indicators are used to give confirmations of these things. And for me, you'll find out in due course that I'm not a big believer of indicators. I believe them to be lagging. And there are a few old school indicators that you know, my personal family have used in the past, as we come from a background of 40 years of trading. So when price reverses this particular point here, yes, you can argue that, yeah, great, we actually didn't have a trade there for a sell, but now price has rejected a previous swing area. Can you see we're continuing adjusting areas and selling downwards? You would use essentially this area here, and this area here. So if you don't get a buy trade here based upon a rejection candle with the body on top and a long wick downwards, as you can see it was underneath, and most people, a lot of people, sorry, would be selling down there as well. So already it would be too late for them and the price is going up, so they have to cut out their trade, or essentially they would leave it open before it comes down. And you know, you wouldn't be wrong if you left it open and you were to sell there, leave it open for that long before it came down. Even if you were going to have your stop loss as a previous swing high, top of the previous swing high, it knocked you out of your trade. And this happens ever so frequently. So when price does come down here and comes back up again, you look for a potential sell trade at the top once more, readjusting your lines. And once again, we've chosen an area just to be fair on most people and not use broad areas, so we can actually be realistic about the more seasoned price action swing traders and show you how they would still essentially face those same challenges. So price was there, created a beautiful reversal candle, and you were selling. Now, if you were looking to take your profit nicely and a little bit more assured, then you probably use an area like this where price is a little bit higher. I could have easily drawn this area here, but we're going to use a previous area here to see how close it came to that. Now, once again, we find ourselves in the same predicament. If we were selling there, great. You know what? If you were selling and you were able to maintain that trade and hold that position open, then you could have taken your profit out 4/5 of the way once again, you know, in accordance to the previous swing area. Or you could have taken it out 1/4 of the way. But soon we'll talk about that 1/4 of the way example to see sometimes, you know, and for the majority of examples we see now, it has gone 3/4 of the way. But can we use that as an answer? I find that a little bit ambiguous, and no doubt most of you guys who are seasoned in analysts will as well. So when going short here, price is coming down. And once again, if you set your take profit at this point, it reverses before it hits take profit. Now, why does this happen? Well, you know, firstly, everybody's looking at these raw targets in these conventional areas, which gives the banks and other traders and hedge funds an incentive to reverse price at that particular point. Look, if price becomes too predictable, then everybody could be making money every single time. So there has to be some sort of balance between there. You have to have losers to have winners, essentially, right? So when price comes down, it doesn't hit target. If you just take it manually, once again, great if you knew where that was going to go. However, this could have been whilst you're asleep. It could have been something where, I mean, this particular candle here represents a 6 a.m. candle. So for the majority of us, yes, we're awake, but are you looking at the charts at that particular point? So price came downward, didn't hit target, reversed at that point, and it only took a couple of hours or potentially a couple of minutes in that 4-hour candle to hold that position there. Now, at this point, even the seasoned traders could hold that position open, considering it's not anywhere near your stop loss. And what we'll find is that as soon as people hold that position open, price continues to go upwards. And for the majority who've been selling down there, seen their profit deplete at that particular point in the market reversing, they will, you know, basically close out their profits for whatever they can take at that point in time. So they can come out with something or the other, at least break even. And no one really wants to break even, but it's an important part of trading if you know you use your intuition. But you know, it's not something that I use, nor is hedging either. So when a person is selling there, like we said, price doesn't hit there, misses your TP just minimally, and sometimes that could absolutely scrape it by a couple of pips and reverse at that point, and you could wake up to major losses or your stop loss being hit. That's providing you put a stop loss in. So if we were to put a stop loss here in a conventional area, a lot of people do, they would generally look at the swing high or maybe above the wick there, depending on their target. And what you'll find is if you sold, held that position open for a while, eventually it came down. But when you're looking at things in reality like this, what would you do in that particular position? Would you go to buy at this particular point, seeing how it's changed direction and it's reversed? Would you start selling again at the top when it's given a signal based on a previous area and you're already in a trade with the potential of making double profit or even double loss? What would you do? Because essentially what you're using is the same area, you're just trading in two different positions. So once again, it gives some nice rejection candles with new areas or roughly the same areas it's been hitting before, and price this time comes down quite vehemently and strong, and heavy bearish candles, and eventually hits target, and it surpasses that as well. So what we're trying to conclude from this particular scenario is not the fact that price actually responded to the area. It gave us a signal for a sell and eventually it went down, and it always does that, so all we need to do is wait it out. That's absolutely not the conclusion we should take from this. We should be looking at tighter take profit targets and not be greedy, because conventional areas are being manipulated to stop your trade from meeting the target, because it's such a predictable area, and stop losses being triggered. Now we just have to look across board, and we can, you know, shimmy back a little bit here and see that no matter what area you look at, we can even look here that, let's take this conventional area here, it's been responded to a few times, or let's take a bit of a better area actually. Yeah, so something like this where prices hit multiple times. There are multiple breaks on this floor here, and let's say this was the ceiling here. Between this area, which is a nice broad area that you can try and make profit between, after these areas are drawn out, you can look to buy and sell between this area. So if we go forward here, we'll find that actually price does sit between this area the majority of time. However, it is key for us to understand that when this went up here, how could we have determined this was going to be a buy trade at this particular point and we could capitalize on it? And why wouldn't we have sold at this area right here when price closed underneath doing the opposite? So if buyers are buying at this particular point because you see rejections of price, if there's no rejection of price and it closes underneath, then surely you should be doing the opposite because it's done the opposite, right? So to what extent could we have understood that when price broke this floor, how far it was going to go down maybe before it was going to go up, right? And once again, we look at this top point here, and when price closed underneath, people would have sold potentially. Or if they're already in a buy trade because of this rejection candle, based upon this previous area where the wick broke and it was top heavy, they would have bought and probably put their stop loss under what did we say before? Under the swing low, only to be knocked out minimally. And when that happens, you know, buyers will be buying again, you know, and you'll get sentimental traders that will be just buying based upon riding the wave and meeting a target there. So that's one, we can say that's one target met eventually. Is that making up for the previous loss that you made based upon this trade and just breaking even essentially? Or, you know, how many times can we replicate this? And what we can see is inconsistencies in the support and resistance levels, and it never really cleanly oscillates and moves up and down between the high and low areas, even if we update and change these areas. For example, let's say that area which has been breached we no longer use, and we use a next high area there, and we use the most recent area here. Once again, you'll find that price breached an area closed above, which will trigger a lot of people, to buy up here, and all the price does is it comes back down again and eventually comes here. So you get a lot more people using these as rejection type candles that broke in a previous area to start selling. But surely you would update your area, wouldn't you, to use that area there, which means that you wouldn't really essentially have a signal there to sell. And the only time we can really see a strong signal to sell as a rejection is when we look further down here. So it's easy to overlook this roller coaster of emotion that is designed to throw us off and to prompt us into multiple trades. Because look, the idea is, and this is how, you know, we know it's a business, the whole financial market side of things, is that the more you trade essentially, or the more prompts you have to enter a trade, the more brokers make, the more the liquidity providers make, the more the central banks make, investment banks make, and then central banks make. So rather than allowing you to predict fully that price is going to go down without any kind of, you know, without being thrown off, essentially, what's being done here is we are being triggered into multiple false movements upwards and downwards to give the impression things are going up, and that's even without drawing trend lines at particular points to suggest price is ready to go up. For instance, right now, when we look at something like this, many people would consider this a trend upwards, including, you know, these areas here, and nothing happened but a momentary push upwards before it retraced and came back down again. Some people call it pullbacks, some people call it retracements, some people call it corrections. Either way, it's three of the same thing essentially. So price does pull up here, doesn't give you a signal for a sell as a price action trader would look at here. So we could essentially take that trade if we are following rules. And this is what we're trying to say, that if you are following rules, then there would be no trade there. But it's easy to overlook that and say, had we sold there at that particular move, then if we'd left it open, it would have hit your target beautifully and we would have made it a trade there. The same thing, if we look in the opposite direction and price comes here, we would buy at that, essentially price action swing trader, would buy at that particular point and look for a long trade here. And they would readjust their target essentially to something like this possibly, or even maybe a support level, right? So, you know, a ceiling can be a floor and a floor could be a ceiling essentially. And, you know, like I said, for the seasoned traders, they'll understand. Anyone who's done some sort of basic reading around support and resistance levels know that you can use a floor as a ceiling and a ceiling as a floor. So let's say we use this reduced area here to buy when we see the rejections down here. Once again, if we were to buy any of these rejection candles after they closed above and created a long wick downwards, highlighting that they've been oversold, you'd put your stop loss just under the swing low, let's say even a bit lower, and price broke this, knocked you out of your stop loss had you put that in that conventional area, which, you know, most people would have, you know, no other area to, you know, better area to put that, keeping your, you know, your risk tight as possible. And price reversed back round. Now, let's say that you were running without stop loss for whatever reason. You shouldn't, but let's say you were, and you were buying at that particular point. What's to say this particular candle here, because it's done the opposite after you were buying and it closed underneath, giving the impression it's going down now when you're looking at it like this, and it's created lower highs and lower lows, right? So when it creates lower highs and lower lows, for most trend traders, this is a strong indication that price is actually pushing downwards. And I'm just speaking generally right now, just to give those price action traders benefit of the doubt in this situation. And when we look at something like this and price breaks underneath and closes underneath, yeah, I mean, you know, there's strong sentiment that price is going down. So a lot of people would be going short at that particular point because it's done the opposite of what their expected candle was going to do. So essentially, some people be in two trades. Some people would have waited and weathered the storm somehow, but waiting means that you could potentially lose out on prices shooting up and hitting your target. So a lot of people would be taking advantage of what they've been waiting for. Two strong, bullish looking candles that are rejections of price based on a previous area that they've drawn. And yeah, you can see that wicks have responded to this area in the past, which has given people the incentive that, hey, this is a good area to trust. Price comes underneath, doesn't go down. You know, most people would be looking at going short here as well. A lot of people would be looking here to go short. I keep saying most people, but a lot of people would be looking to go short here. Selling to maybe a bottom area or roughly an area downwards here, somewhere midway or even all the way down to the bottom swing, roughly around this area here. And, you know, eventually, did it come down? Absolutely. And look at how it responded later on to that area there. And it barely skims it before it decides to change direction at that point. Once again, signifying that these conventional support and resistance levels or peaks and troughs that you can see and are observational to the entire market are dangerous. So price does close underneath here, gave the incentive it was going to come down, came back up again. What would you do? Would you cut your trade off? Would you cut your trade out and re-enter at this particular point and target upwards in this area here that we discussed before? If this is your target one, and that would be your higher target if price goes towards there, then why did it fall short of there and reverse at that particular point? Before, in the two examples that we gave, it pretty much went 4/5 of the way, but this time this went 3/4 of the way. So we can't absolutely say the price has gone to that area. So its price is going to go 3/4 of the way or halfway. So when any trader has left their trade open, let's say without running a stop loss or running a deeper stop loss around here, for example, and it wasn't triggered, they would eventually make profit. But how confident would one be if you left your trade up that long and you intended for it to go to that particular area or further up? Because at this point, you know, a lot of things are triggering greed into that point and saying, hey, why don't I move my take profit level higher up and my stop loss maybe wider down if it was, you know, in this particular area. And if it's going in your favor, you would try to widen it as much as possible. But we all know that essentially sometimes what can happen to price is price could push up quite strongly and then reverse and come back down, and would have triggered you into a trade at that particular point midway, or you would have had your trade there and then basically, like I said, move your take profit higher, or at this point when you see it reversing down, you'd move it lower. So when watching it like this and it's created again once against lower highs and lower lows, what would you do when price is heading down this way? Sentiments are now different. They're now showing that price could come down and hit a bottom area. And once again, it's repeating the same behavior it's done again. If you're looking to sell here for whatever reason, I'm not even talking about price action swing traders. I'm just talking about based on sentiment and looking at the market. You would have sold and price didn't quite meet that target. So what's happening is, yes, broadly, when you look at things, it's really easy to say that price is bouncing up and down between these areas, and eventually if you leave your trade open, it will hit that area. No doubt, this is what institutional traders do. And they don't run with stops. Stop losses are designed for retail traders, and stop hunters are used by the banks to, you know, knock us out of our trades. Essentially, it needs to fill the market full of liquidity, right? So we see between here, price is not meeting midway targets or top targets, and it's not meeting price when it comes all the way down. Only some scenarios show some sort of confidence with a system like this where, for example, price is being rejected in this area based on the previous areas there. Let's delete these. Pushing upwards, so you could buy potentially with this rejection candle, and actually this is quite a clean move. Try and mimic the same at the top by looking at a reversal candle there now. What happens? Can we say we need to target midway and then take profit out at this level, like a mid-level here or something like that? Is it only hindsight that's allowing us to draw that area? Would we have chosen an area maybe something like this, which is something like this, or so on and so forth? And so we need to know to what extent it's going to come down when it bounces, and when it breaks, to what extent is it going to go up before it reverses. And in this area, we find that this gap would have easily knocked one out of their stop loss. So if you were selling at this particular point, like we said before, you'd probably put your stop loss around this area, maybe a little bit higher at there. You'd have been knocked out your stop loss before price decided to do what? Reverse back round and come down to exactly the same point that you originally wanted to target towards. So the real challenge here, and you can see my frustration with explaining this to you guys, is no matter where you draw a line in areas for resistance or support areas, they're always going to inconsistently bounce and break. And this will have a direct effect on your stop losses being triggered. If you were selling at this particular point, minimally, your stop loss get triggered. Absolutely minimally, just even by a couple of pips. And how many people have been through that? You know, you could leave comments in the section below and let me know how many of you guys have actually experienced your stop loss being knocked out by a couple of pips before it decides to reverse. And at that point, you haven't got enough margin, you don't have enough equity, and you can't take that risk to make up for your losses. And in fact, a lot of people after those losses will probably try and double up on their trade, and who's to say that isn't going to continue to trend upwards at this particular point, which it looks like it's potentially going to do, and this is a low area. And again, I don't use trend trading in my personal trading style at all, but it's a general indicator. Once again, it's a general indicator. So price did break that, knocked you out of your stop loss, then it came back down. And if you were using a actual low area, an area that's hit before, let's say something like that, and price reverses at that particular point, now it's easy to choose an area like this when really and truly this is a much clearer area, this one here. So if you were choosing this area and looking for a buy trade in a rejection candle here based on price action, you would have got a trade for a while, right? So what would we do? Would we wait? Would we look at another currency? Yeah, sure, look at another currency, but the barriers of entry and the problems still remain. So if we were to choose an area like this, a mid area, let's just say for the sake of giving, you know, price action swing traders benefit the doubt, price broke here and reversed, creating a strong rejection, and you could have bought. Once again, where would your targets be at the top? Would it be here? Would it be a reduced target there? And I can assure you now that if you were to use this reduced target here and remove that original stop loss, if you were to buy here, remove that original target, what's happened? Price has gone up here, and yes, like I said, it's all good and well if you're awake and you're watching the markets, and you can, you know, literally just take your profit out as soon as it touches a particular area. But if your take profit level was there and price went there, this particular currency is a good 6 pips on FX Pro. So if we look at how many pips there are there, 24 micro pips, 2 pips, price didn't even cover spread at that particular point and cover the difference between the bid and ask price, and reversed in the opposite way. So once again, if you're awake and you can take your profit or a portion of it, fantastic. But this is only in hindsight where we can see price did reverse at that particular point. And are we covering losses from particular areas where price didn't come down, yet we were triggered into a trade at this particular point? Do you see that? Would we have taken that buy trade at that particular point whilst in a sell trade? So what are we doing? Are we yo-yoing? Are we making money, losing money, making money, losing money? Price does 2 things between any given area. It bounces and it breaks. Sometimes it doesn't fully break, sometimes it doesn't fully bounce. And no matter what time frame you look at, even a 15-minute time frame, let's look at a 5-minute time frame. I didn't use any of these shorter time frames, but okay, let's look at a 15-minute time frame, let's say, for example. you find yourself in the same predicament once again. So if we look at areas accumulative like this, and something like this, for example, we can see that yes, although it hasn't breached a ceiling at that particular point, when price broke here, it reversed into an area. Now, reversing back into the area doesn't mean you should buy immediately, because where do you buy to? Do you buy to this reduced area here, which is more of a safer target than the original area and newer data than the original area there? And yes, singularly, it doesn't look like a strong area on its own, because it doesn't look like it's repeated itself much within this screen. But it doesn't reach there, reverses once again, triggers you into another sell, creating a roller coaster of emotion, which essentially gets you to buy, sell, pay spread, and basically take your trades out or get hit out by your stop loss. So these problems in trading of price inconsistently bouncing and breaking, and price breaking prematurely, ceiling prematurely, and breaking a floor prematurely. We could even use like a wider area. Let's say just to be fair, we'll use a swing high and swing low there. Price broke an area only to come back up again. Price broke this area only to come back down again, and it didn't even come all the way down to this this bottom area here. So price breaks a ceiling or breaks a floor. Sometimes it doesn't fully break up, sometimes it doesn't fully break down. And if you're looking for bounces as a price action swing trader based on this popular approach in swing trading, sometimes it doesn't even hit target 3/4 of the way or 1/4 of the way. And at what particular point will you sell when you see the market reverse? Are you selling at the top point? Have you caught it at a midway and the price is ready to reverse at that particular point? You can see multiple fake breaks downwards at this particular point that give us the incentive that it's ready to come down. Price, even at this particular point, would have gone all the way down, maybe close to your target, but if you weren't there in time or weren't fast enough, it could have pushed down really fast in a couple of seconds and retraced upwards, not giving you enough time, and you definitely hold your position open to try and capitalize on as much profit as possible. There is nothing after the next consecutive candles like this giving you the incentive that it's ready to reverse. And there is even a rejection candle here, type candle, reversal type candle here, suggesting that price is going to continue downwards with, lower lows and lower highs potentially being created in some scenarios as well. So these are multiple prompts of short trades and sell trades which sellers would be getting into, but unfortunately they'd have to cut the stop loss, they'd have to cut their trade out. They'd be buying instead whilst their sell trades are open to try and hedge the trades. They'd be knocked out of their stop losses if they're using previous high areas, something like that, or even here further down the line there, only for price to come back down eventually. Like I said, are you and I eventually traders? And the answer is no, we don't want to be eventually traders here. So really, we need to solve this problem. If this is a common occurrence that happens in every swing point on a daily basis, hourly, 15-minute, 5 minutes, or 1 minute chart, whatever you're looking at, can we solve it? Because if we can solve this and know when price breaks prematurely and fake breaks upwards and downwards from a ceiling and a floor, maybe we can actually have a solution to that. Because it's a frequent occurrence, we'll therefore get frequent trades. So I present to you the problem of price action swing trading as well, but also present you the problem of support and resistance in its conventional form, which is key areas where prices hit multiple times. You can apply and practice this yourself on any time frame and any chart, and let me know how you guys feel in the comment section below. Please like, please subscribe, and there will be lots more content to come. Any guys want to ask me questions, you're welcome to. And yes, I'm signing out. Thank you. Bye-bye.